Bitcoin slipped under $118,000 after hotter-than-expected PPI data reignited inflation fears, triggering a sharp correction. On the daily chart, we saw the first bearish engulfing pattern since mid-July, which has traders worried that seasonal weakness during Asia's ghost month could drag the market lower. Even so, on-chain metrics continue to show strong dip buying, and that demand has helped prevent a deeper slide for now. In today's video, we'll break down whether the hot PPI print really changes the bigger picture for crypto, or if this move is just a shakeout before higher levels. We'll also explore the scenario where September doesn't bring a massive pullback, and how that could set the stage for a strong final quarter of 2025. If you find value in this, don't forget to hit the like button. And if you're new here, subscribe so you never miss the next update. Now let's get into it. The release of the latest U.S. Producer Price Index report shook the crypto markets midweek, sparking a round of profit-taking. The market had expected a print of 2.9%, but the actual number came in hotter at 3.7%. This immediately raised concerns about renewed inflationary pressures, largely linked to tariffs and rising supply-side costs. The reaction was swift. The US dollar strengthened, treasury yields ticked higher, and risk assets including Bitcoin and altcoins saw a pullback. Leading into the PPI release, Bitcoin and ETH were trading right near their all-time highs, backed by strong momentum and growing institutional interest. The hotter-than-expected data disrupted this sentiment, pushing Bitcoin below $118,000 as traders reassessed exposure to risk. Yet despite the drop, the broader trend remains unchanged. The correction looks more like a technical breather than the start of a larger reversal. Institutional demand for both Bitcoin and ETH is still accelerating, which continues to provide a strong base for the market. This is why the current dip could be a healthy shakeout and a potential buying opportunity rather than a sign of weakness. The focus now turns to how markets digest the data when U.S. equities open on Monday. That reaction should give us a clearer signal on whether crypto quickly regains its upward momentum or spends more time consolidating before the next leg higher. Now the Federal Reserve's upcoming policy decisions remain a key focus. Earlier in the week, the release of CPI data had boosted hopes for a larger-than-expected September rate cut, but the stronger PPI print has dialed back those expectations. According to the FedWatch tool, there is now a 92% probability of a modest 25 basis point cut, with just an 8% chance of no cut at all. While the shift in the market narrative has created short-term uncertainty, it hasn't translated into bearish conditions for crypto. In fact, the broader market continues to show resilience. The Coinbase Premium Index pushed to its highest level in a month yesterday, pointing to sustained U.S. spot demand. Even as Bitcoin pulled back, dominance failed to break above 60%, highlighting continued appetite for ETH and other altcoins. The ETH-BTC pair is still trading comfortably above key levels, which adds strength to the altcoin narrative. Momentum is also visible in stablecoin activity. Since the latest dip, USDC inflows to exchanges have climbed to $3.88 billion, a clear sign that traders are preparing dry powder for deployment. Capitulation signals also remain muted compared to prior corrections. Just 16,800 BTC were moved to exchanges at a loss by short-term holders, well below volumes seen in past sell-offs. For context, previously when Bitcoin dipped more than 5%, over 48,000 BTC were sold at a loss by short-term holders. That contrast suggests confidence remains intact, and many traders are holding firm rather than panic selling. In summary, while the hotter PPI data triggered a brief correction and tempered expectations for an aggressive Fed cut, it hasn't derailed the broader bullish structure. Short-term volatility like this is part of every cycle, but the data still shows strength under the surface. Stablecoin inflows remain elevated, Bitcoin dominance is failing to break higher, and ETH-BTC is holding key levels, all pointing to steady demand for altcoins. As the market digests the latest macro signals and looks ahead to the Fed's September meeting, the question is whether this pullback becomes fresh fuel for accumulation or just a pause before the next leg higher in the bull cycle. Alright, now let's shift gears and look at the other side of the story. Everyone, including me, has been cautious about a possible September dump, but there are also strong reasons why it might not play out this time. Let's break down those factors. Mark Twain once said, "Whenever you find yourself on the side of the majority, it is time to pause and reflect." Right now, that majority includes me and pretty much everyone else calling for a September dump. But when an entire market is positioned for the same outcome, that's often when the market does something completely different. I've been harping on about September historically being a brutal month for crypto, and honestly, the data backs that up. But markets evolve, and this cycle has thrown us more curveballs than I can count. So instead of just parroting the same bearish September narrative, let me walk you through why this time might actually be different, and why we could rocket straight into the final quarter without the pullback everyone's expecting. Sometimes the most contrarian play is admitting you might be wrong about your own thesis. There are some solid reasons why we could keep pumping even in September, the biggest one being ETH strength and corporate treasury accumulation. ETH's momentum is undeniable. Corporate treasuries are aggressively buying ETH, with firms like Bitmine accumulating over 1.17 million ETH. For the broader altcoin market, ETH acts as a proxy, and this institutional buying pressure creates a strong foundation. BlackRock's ETF alone saw 640 million in single-day inflows, while total ETH ETFs recorded over 1 billion in net inflows for the first time. This is institutional capital positioning for sustained growth. Growing strength of ETH has also contributed to the fall of Bitcoin dominance. It continues its relentless decline below 60%, showing genuine structural weakness. Even during the recent dump triggered by hot PPI data, Bitcoin dominance couldn't reclaim the 60% level. That is a critical technical failure that suggests the rotation into altcoins has real momentum behind it. And if this rotation continues to build steam through September, then the dump month everyone's preparing for could instead turn into the launchpad for the next major leg up. While Bitcoin dominance has slipped under the crucial 60% level, stablecoin dominance hasn't broken down yet. A true Altseason historically requires stablecoin dominance to fall toward 4.88%, the same level we saw during the March and year-end 2024 rallies. Right now it's still around 6%, which means there is a large pool of dry powder sitting on the sidelines. Once that capital rotates, it creates the kind of liquidity surge that fuels broad-based altcoin rallies. September could be the trigger for this rotation. A Fed rate cut is widely expected, and while many see it as a panic move in response to weaker labor market data, the fact remains that lower borrowing costs are bullish for risk assets. On top of that, $7.2 trillion is currently parked in money market funds. If even a small fraction of that capital gets reallocated in search of higher yields, crypto could be one of the biggest beneficiaries. This cycle is also different from the past. In 2025, we have institutional-grade infrastructure that didn't exist before. Bitcoin and ETH ETFs alone have seen nearly $30 billion in inflows year-to-date, and institutional surveys show more allocation plans coming. This creates real, sustainable demand rather than just speculative retail bubbles. The regulatory backdrop has also improved. The Trump administration is pushing policies that could unlock access to $43 trillion in retirement savings for crypto markets, while the SEC is providing clearer guidance around staking and DeFi protocols. On the supply side, exchange balances for major altcoins are at multi-year lows, while corporate treasuries are steadily absorbing available supply. Add to this the fact that ETH's 30% staking rate keeps a huge chunk of tokens locked up, and you have the kind of supply squeeze that typically precedes explosive moves. The historical narrative of a September dump may simply be a statistical relic of an older market structure. The crypto market today could be shaped more by three powerful forces that have the potential to outweigh any seasonal weakness. First, the on-chain fundamentals show a market that is healthy, not overheated. ETH's structural supply squeeze from corporate accumulation, combined with the unprecedented pile of sidelined capital in stablecoins, creates a steady underlying bid. That makes sudden downside shocks harder to sustain compared to past cycles. Second, the demand side of the equation has completely changed. The consistent inflows into spot ETFs from major asset managers and endowments have added legitimacy and durability to this market. This isn't speculative short-term hype. It's a long-term allocation of capital that cushions volatility and provides real buying pressure. Third, the macro backdrop itself is acting as a tailwind. Markets are already anticipating a dovish Fed pivot with a September cut on the table, and historically that kind of shift in policy has boosted risk assets. Instead of draining liquidity, the environment might actually encourage flows into crypto during this period. So while September has a reputation for weakness, the confluence of institutional adoption, clearer regulation, and technical setups across altcoins suggest this cycle could play out differently. And if September ends up being stronger than expected, it could set the stage for an even bigger melt-up into the final quarter, just as institutional allocations ramp and retail momentum kicks in. When everyone is positioned for a dump, the market often chooses the path that hurts the majority, which in this case could mean surprising strength. What do you think? Are you still in the September camp, or do you believe we could skip the dump entirely and head straight into a bullish final quarter? Share your thoughts in the comments below. I always enjoy reading your takes. Thanks for watching, and I'll see you in the next one.